is a finance professional with experience in financial services across a range of functions, including asset management, research, and global markets. She's currently a research analyst focusing on macroeconomics, debt and equity capital markets, and foreign exchange strategy and investment bank in Nigeria, with clients spanning across local portfolio and fund managers, as well as foreign portfolio investors. Prior to this role, Oyinkansola worked as a wealth manager in an asset management firm in Nigeria. She holds a bachelor's degree in chemical engineering from the University of Lagos, and she's also a CFA Level 3 candidate. She's passionate about women and women's rights, and her hobbies include traveling. So maybe you take us on one of your trips, and trying out new restaurants. More recently, she spent her free time trying to learn to play tennis. Well, that's so awesome, and I hope you would one day teach us how to play tennis, right? So over to you, Oyinkansola Samuel.
Okay, thank you, Grace. Can you hear me? And am I echoing? Because I'm trying to do this from 2 devices.
No, it's fine.
Can you hear me well? It's fine. Okay, cool. All right, thank you very much, Grace. Thank you for asking me to speak. Let's not get into how we know each other, but we've known each other for a long time. So this is, it's really special that you asked me to do this. So I haven't really done this in a formal or semi-formal setting. So I guess this is me, launching my public speaking career in front of all of you. But, like you said, I work in finance, and because I work in finance, I'm always getting questions from my friends about what to invest in or how to invest, which, is a pretty loaded question. And I'll get into why. But like you said, I'm very interested in getting women to start investing as quickly and as diversely as possible. Quickly because time is money, literally. And diversely because the principal rule for investing is to diversify. When I think about older women in my life, I think about how much more wealth they could have amassed if they had started investing in their 20s or 30s or even 40s. But really, it's never too late to start investing or growing your wealth in really what is a relatively passive way to earn extra income. So I will get started. Grace asked me to speak on, forgive me, my eyes are darting, and again, I'm doing this out of 2 screens. Grace asked me to speak on personal finance. I put my twist on the title and called it Getting Started on Investing. She also asked me to speak to budgeting and saving, which I will do during the course of the presentation. I do have slides, but nothing to, it's echoing.
Just a bit, someone says that.
Is it echoing for you though?
No.
Okay. It might just be that person, but if it's echoing for any other person, they can just let us know in the chat. So I will try and fix it. Okay. So like I said, I have slides, but it's nothing too academic. It's just to guide the conversation. So I will start. What I'm hoping that you will learn from this today is first, investing and capital market basics. I'm hoping that you will learn about the power of compounding in investing. I'm hoping that you will learn the right time to invest and also risk return trade-off. So we'll get started. The process is easy-ish. It's you budget, you save, then you invest in a way. I'll start with budgeting. So consciously or subconsciously, I think that we all budget. If you say you earn like 10,000 naira, or wait, I know this is a multi-continental, multinational audience, so I'm gonna try and move between currencies, but just stay with me. So if you earn, say you earn, 100,000 naira, 10,000 naira, in your head, I'm gonna take 1K and do my hair. I'm gonna spend 2K and buy fuel. So you're budgeting but you're doing it subconsciously. But the trick to discipline in budgeting is to move from doing it subconsciously to a point where you're intentional about doing it. You're drawing up a budgeting plan, you're creating your own templates on Excel, which is what I do. But even outside of that, there are many generic templates on the internet. There are apps that you can use to budget on the App Store. My sister is kind of like she's the budgeting queen, really, and she has this app that it is so detailed that it will go into your bank, your bank alerts, and basically pick up what you've spent money on and populate your expense tracking sheet. So say you spent 5K at ShopRite, it will then say, oh, shopping or grocery shopping, and it will say 5,000. So there are many tools, really. Budgeting is the easiest step here. It's also a really critical step. It's the first step, it's an easy step, but it's a critical step. Countries' budgets, companies' budgets, the largest corporations that have access to so much money, if they went to a bank and asked for a loan, they budget. And budgeting is even done ahead of time. So you're not budgeting as you go. You don't get your salary and then, oh, now I want to budget. But you budget ahead of the cash inflow. So yeah, I think it's the easy step. It's the first step, but it's a critical step. And what's important to have in your budgeting sheet is to have it savings as a line item. Many people say you should actually, like, savings is what you should allocate funds to first before you do any other thing, because it's very easy to skimp on saving and then just finish your money and then you really have nothing to save. So savings should be one of the line items, or one of the very first line items that you populate in your budgeting sheet. There's a budgeting tip, or it's kind of like a guide that I believe it was Elizabeth Warren. She's a senator in the US. She wrote a book in the early 2000s, and she came up with this budgeting rule. She calls it the 50-30-20 rule. So it says to allocate 50% of your income to your needs, and that will be things like your rent, your car maintenance, insurance, health, giving. I consider giving a need. So allocate 50% of your income to that. Then allocate 30% of your income to your wants. I'm a believer in enjoying the money that you worked for. So if you want to buy, I don't know, a wig or whatever it is you want to buy, you can allocate 30% to your wants. And then allocate 20% to savings. Now this term savings, right? I have an issue with it, because you could decide that, oh, I want to buy a car in 6 months. So, and this car is going to cost me $6,000. So I'm going to save $1,000 anymore. So you just put the money in your bank account somewhere. Each month you're saving 1,000, and it's just there in your bank account. And God forbid, if that bank account is in Nigeria, you're sitting there is earning you 0%. Which is why I have an issue with word saving. I want us to start to think of replace saving with investing. That money that you have that has no immediate need, you don't need it until 6 months' time. It shouldn't be sitting in your bank account. I'm very anti-bank accounts. I think you should be putting that, in fact, I don't think, you certainly should be putting that money in some form of investment vehicle that is earning you something that is not 0%, which is what your bank account will give you. And so when, I know that traditionally everyone is familiar with savings as, setting aside money for a later date, but that money that you're setting aside, if you don't need it today in the very immediate, I think you should be considering it your investment sum. Now, people, traditionally people have thought of investing as, if I want to invest, I need a huge sum of money, like I need 1 million naira, or I'm going to have to tie this money down for 6 months or 18 months before it matures. But it's 2022, and there are lots of investment vehicles that you could literally put in your money today. And if there, God forbid, is an emergency and you need that money, you can take it out tomorrow. There are investment vehicles that do not need you to start with 1 million naira. Now, I can't speak with a lot of authority on the US or North America in general, but in Nigeria, there are investment vehicles that don't require, you literally could start with 1,000 naira, and that's like $2 to you people. But obviously, the circumstances are a bit different in North America. So I want us to start to move away from the idea of saving. I'm just going to keep this money in my bank account, because you might as well just put it under your pillow, honestly. Like, then at least you won't get bank charges for that. So move away from the idea of saving and start to think of that pool of funds that you have no immediate need for, and think of it as an investable sum. So with that, I will move into investing. Okay, sorry, I was just reading your text. Yes. And with that, I will move into investing. But I want us to understand how money works better. So there's this concept called the time value of money. And I'll start with the question before I go into it. So if someone wants to buy you a house that's worth $3 million in December, would you rather they give you the money now or they give you the money in December? If you could just type now or December in the chat. This person is trustworthy, this person is literally Jesus. For sure, they will give you the money in December, so they're not running away. But just type in the chat if you would rather have the money now or if you'd rather have the money in December. Okay, I'm just gonna check the chat. Okay, so a lot of Grace, your audience is, their money serve you. Are you sure you need me? Yes. Okay, so that's really the answer I was looking for. You would much rather have the money now, and the reason is simple. Money, they say time is money, and that's pretty accurate. Money has value over time. Think about, say Dangote wanted to borrow money from a bank to finance his refinery, just hypothetically. He's building a refinery. Say he wanted to borrow money, and he walks up to the banking officer, and he's like, "Oh, I want 5 million." And they're like, "Okay, we'll give you 5 million at 10% per annum. That's the interest rate." So they're going to give Dangote 5 million today. But at the end of the year, Dangote is going to have to pay back 5.5 million. The worth of that money to Dangote was 5 million. But unfortunately, money has value over time. And to the bank, that money is valued at 10% over a year, such that 5 million that I give you today in 1 year, I think is worth 5.5. And a lot of people think, oh, the bank is just trying to make a return. But no, that's really money. Money put to use should increase in value. And so that's really that's the point of the concept of time value of money. The future value of a particular sum should always be higher than the present value of that sum. So 5 million today to that bank is worth 5.5 million in the future. Now, because Dangote even understands that concept, if at some point during the year somebody gives him 5 million naira, or he's able to borrow 5 million for cheaper, maybe now at 2% from another bank, let's believe he's going to go and return, the money to the initial bank, and then get the money for cheaper, because the worth of that money to that bank is 10%. So he's going to pay down on his debt earlier if, one, he's able to raise the money on his own, or he's able to refinance it at a lower investment rate. And that's really what time value of money is. Money you have today, you have so many opportunities to be able to grow that money and make it even bigger at a later date. So if anyone, this is why when people, if I'm owing my sister money, for example, and then she'll come and say, oh, you have to pay me back with interest. And it's true, because she could have as well put that money in her investment account and it would have been yielding something for her, but I borrowed it. So if I'm going to pay her back, I better pay back with interest, even though I don't, but you better pay back with interest. So don't let people owe you money for too long, because that's money that could be growing with time. Closely linked with time value of money is the power of compounding. I think compounding is like this is the best thing about investing. It's like, it's the closest thing. It's not a money doubling scheme, but it really is the closest thing to a legitimate money doubling scheme. Now, I'm just gonna explain what compounding is. And I know we all did simple interest and compound interest. I think it was either primary school or secondary school. We sure I did it. Simple interest was, they'll just give you the principal, the rate, the time, and say you have 100,000 as your principal. The rate is 10%. It's for 1 year. That your 100,000 is going to earn 10,000 at the end of the year. At the end of the year, you have your 10,000 principal back, and you have your 100,000 principal back, and you have your 10,000 interest, right? Now, what compounding does is that you're going to take that 10,000 interest and you're going to plow it back into the investment. So you're going to add it to your principal. So now your principal for the next year, now you compound over a period of time, right? So in this scenario, we're compounding annually. So your principal for the next year is the 10,000 interest that you made in the first year, plus your initial principal of 100,000, which is now 110,000. So in the second year, you're earning 10% on 110,000. So your interest for the second year is 11,000. In the third year, you're going to add that 11,000 back to your 110,000. You have 121,000. You're going to earn 10% of that. You have 12,100, and so on and so forth. Now, I did this sample compounding, analysis, and I pasted it here on the slides for us to see. So that same $3 million that someone's going to give you to buy a house, say you just thought to yourself, man, I don't need a house, I'm going to invest this. I put the interest rate at 10.5% because that's the US stock market has returned 10.5% on average since inception. So it's a realistic interest rate. So you put that $3 million that they gave you at 10.5%, and you just leave it to compound annually. In 30 years, you would have increased that money by 20 times. Your 3 million is now worth 16 million. And in places like Nigeria, 10.5% is actually it's a relatively conservative interest rate. You can get higher, So and this really is how people are able to grow their wealth. What this means is that you're not liquidating your interest. You're literally leaving your interest and adding it back to your principal, and you're letting the money just sit and compound. I think compounding is, for one of my investments in Lagos, it compounds quarterly. Also, so the higher the frequency of the compounding, the more your returns, right? So some investments compound daily, some compound monthly, some compound quarterly, some compound annually. So hardly will you find one that does daily or monthly. Usually starts from quarterly, but even at that is, it's a good way to double your money over an extended period of time, or in this case, grow your money 20 times in 30 years. So I'll move on. So why invest at all, right? First, to grow wealth. It doesn't matter how many, how rich you think you are, or how many streams of income you have. Human wants or needs, they're insatiable. So as you grow rich, you're always going to have need for more money. And even if you don't, you become a philanthropist. So there's always a need to grow wealth, to leave an inheritance for your kids. Otedola still invests, Warren Buffett still invests. So that you invest because your money can be doing more, or your money can be growing. You invest, of course, because you want to retire well. And lastly, which this is by no means exhaustive, but I've just come up with this. Everyone's favorite buzzword now is inflation. So you invest because you want to beat inflation. Now, I'll get into inflation on the next slide. Sad news is that inflation is stealing from you. Inflation, by the simple definition of what inflation is that it's the rate of rising prices of goods and services in an economy, or it's the decrease in purchasing power of money. So prior to, I think, last year, inflation really was largely a third world or a developing country issue, right? But right now, in sorry, I couldn't fit Nigeria on this chart because Nigeria's inflation is literally off the charts. But let's just stick with these. I put mostly, developing nations and Brazil, which is an emerging market. But inflation in the US went from sub 2% in January last year to 7% in December. In January this year, I think it's now up to 7.5%. Right now, the best business case for any investment manager is to just tell you that inflation is eating your money, therefore you better be investing. And here's what inflation does. If you had $1 at the start of the year last year, at the end of the year last year, that $1 was worth 93 cents because inflation at the end of the year was 7%. And if you're in Nigeria, inflation was 15.6% at the end of the year last year. So if you had 100 naira at the start of the year, you had 84.4 naira at the end of the year. There's something called your real return, right? So if you had an investment at the start of the year, say in the US, and that investment yielded 10% by the end of the year, your real return is your return over inflation. So in essence, you did not earn 10%, sadly, because there was inflation. But you're still better than most because you earned 10% minus 7%, you earned 3%. Now imagine the guy who did not invest at all. He literally did not earn anything. Then his money got eroded by 7%. So he lost 7%. At least you gained 3%. So that's the best business case that I see for investing right now. There is hyperinflation across the globe. There's almost no country right now that is not above, central banks set inflationary targets for their economies or for their countries. There's almost no country right now that's not way above the inflationary target. And don't get me wrong, inflation isn't always a bad thing if it's within target, but right now it's not within target for a lot of countries. So it's actually a bad thing and it's eroding your income. Now, if you're in Nigeria, you kind of have another, issue, which is the fact that your currency is also losing value. The naira is depreciating faster than maybe like just Venezuela's currency isn't depreciating, is depreciating faster than the naira. The naira has depreciated by almost 100%. I mean, it's gone from 360 to about 600. Late last year, it touched over 600. So the naira is depreciating fast. Now, the solution for Nigerians in Nigeria who earn in naira, to kind of outpace inflation and outpace devaluation, there's almost no textbook solution. But I would say you're better off holding most of your assets in foreign currency at the moment. You just can't, if you just can't find anything that will give you a real return above inflation and above devaluation if you're holding your currency in naira, right? So if you can even just get out of naira, for example, and move to a more stable currency, then you can be trying to earn a real return above inflation. But that's really the situation that we're in. But I would try not to harp on it because I can talk about this currency for a long time. So yeah, best business case for investment in today in present time is the fact that we're in a season of hyperinflation across many countries in North America, developed markets, in developing markets like Nigeria. And if you're in a country like Nigeria, your currency is depreciating. So why are you short? In fact, if even if you're in Nigeria and you earn in naira and you're unable to convert your currency, you're unable to convert your earnings to dollars, at least reduce the loss that you're taking on your currency and on your net worth, right? At least reduce that loss by investing. Yeah, okay. So to get started in investing, right? How do you get started? First, you need an understanding of the asset classes. Asset classes are basically things what you invest in. They're called asset classes. So I will be using that term a lot. There are some that I'm sure we're familiar with: equities, fixed income, real estate. I'm sure we're familiar with commodities. Maybe people are able to invest in gold, people invest in crude oil, people invest in copper. So these are the more popular ones. There are others that include, alternative investments. Alternative investments could be private equity or investing in a hedge fund. There's derivatives, which would be, investing in a futures contract or forwards contract. That's advanced territory. And then there's cryptocurrency. I put here that it's 2022 and we can't ignore crypto anymore. Cryptocurrency is now a valid asset class. It's recognized by many countries, it's recognized by many corporations. In fact, last year, Bitcoin was the highest returning asset in the world. I think Bitcoin returned about 60%. This year is a different story, but just to make you aware that cryptocurrency is a valid investment class. So I'll touch on these one by one and kind of speak to what the risks are associated with this, what they are, what the risks are, what the potential for returns are. So I'll start with equities. If you own equity in something, that means you own a part of something. So if you own a stock in a company, it means that you own a part of that company. So there are companies that are public, and these public companies, they're listed on a stock exchange. So Apple, for example, is listed on the stock exchange, and I can go today and buy a stock of Apple. I'm not sure how much Apple is trading for right now, but I can go and buy one share of Apple, and that means I'm now a part owner of Apple. Now, before I buy Apple, right, I'm gonna have to do some research and say, okay, maybe after doing my research, I believe that we're going to go up to iPhone 100, right? Like Apple is going to be here for the next century, and by then, like Apple will be the only phone that everyone will be using in the world. So like I'm very certain that there's ample growth potential for Apple. I like the management, I like the company, I look at what they do in terms of ESG or in terms of, community development. I'm very comfortable with the company. So I go ahead and I buy Apple stocks, right? Now, if I buy Apple stocks, I'm not a part owner. If my analysis was correct and Apple indeed, they get up to Apple iPhone 100 or whatever, that means Apple stocks will start rising. So I make a gain because, say I bought Apple today at $200. Next year, Apple is now trading for $250. So I made $50 in terms of gains. Now, another way to earn on equity investment is that many companies pay you a dividend. And what's a dividend really? So after a company shares their results, a company that you bought their stock, after they share their results and they made a profit, they will now say, oh, all these are our owners, we need to make them happy. So we're going to pay them something for being an owner, right? So they share dividends. So maybe on your stock, maybe you get a dividend yield of like 10% on you had put in $200 initially. So now you have extra $20. So you've earned 50 by virtue of the fact that the price of the Apple stock went up, and now you've earned 20 because you got dividend income. So that's how to earn a return from investing in stocks. Stocks are not they're not without risk. They're actually considered a risky asset, and that's because stocks crash. Stock prices can go up and they can go down. In fact, on what day was it that Russia invaded Ukraine? It was Thursday or Wednesday. The Russian stock exchange, the Russian stock market dipped by 50%. Obviously that's an extreme case. But if you had bought your $200 Apple stock on the Russian stock exchange, it's not listed there, but let's just stay with me in this hypothetical scenario. your $200 investment will now be worth $100. So stocks are not, there's nothing guaranteed with stocks. You put in your money, you've done your research, you're confident that it's going to go up, but literally anything can happen. Russia could fire a missile into the US, God forbid, and that can cause the stock market to tank. So stocks are, there is risk associated with it. However, there's a saying in finance that over an extended period of time, some people quantify that as 3 to 5 years, some people say 5 to 7, some people say 7 to 10 years, stocks outperform other asset classes. And theoretically, this has been proven to be true. Like I said earlier, the stock market has returned on average 10.5% per annum since inception. For the US market, that is outstanding. In the US market, bonds, 10-year bonds don't even give you 2%, right? So if there's an asset class that's returning 10.5% over an extended period of time, on average, and this average is, there may be 1 year that it returned 44, the next year it returned negative 22, the next year it returned 2. But on average, so the gameplay for investing in equities is to think long term. Don't put your rent money in Apple stocks. Don't put money that you need in 2 years in Apple stocks. It's not the smart thing to do. Now, if say you have a kid that's 5 and you want to pay for your kids' college tuition when they're 18, now it's monies like that you can start to allocate a portion of it into stocks, because over time, there will be losses, in the short term, but over time, your investment, your gains are able to make up for the losses. And this, like I said, is theoretically proven. Another way to gain exposure to equities is through index funds. So remember when I started, I spoke about diversifying investments, because you really can't put all your eggs in one basket. There are people who they're kind of new to investing. I mean, you just buy one, you just come and they maybe buy, I'm going to buy Apple stocks, and that's it. Okay, Apple can literally crash tomorrow. And what if Apple as a company goes under and you don't have, you've lost all your money? So it's a need. This is really the principle of investing, is that you need to be able to diversify. Now, you can either diversify across asset classes, or you can diversify within the asset class. So you can diversify by maybe allocating 20% to equities, 40% to fixed income, 20 to real estate, 20 to commodities. That's fine. Or you can say, you know what, I like equities, so therefore I'm going to diversify within equities. That's obviously not as smart, but at least you're diversifying. It's a place to start. So a good way to diversify in equities is through index funds. Now, I really like index funds. I'm invested in an index fund that tracks the US stock market. Now, what an index fund does is that, basically what I just said, it tracks a stock market. It tracks an index. So in the US, there's the S&P 500. Now, the S&P 500 has 500 of the largest companies that are listed in the US stock market in it. So there's Tesla, there's Apple, there's Amazon, there's the banks like JP Morgan. They're all listed in the S&P 500. Now, some really nice guys take out time and create funds that basically mirror these indices, right? And so you can invest in that fund that mirrors the index. Now, how this is a good diversification play is that you're not just invested in one thing. So in the event that Apple shuts down tomorrow, but maybe Tesla, what's this guy name? Elon Musk, maybe he's now able to go to Mars and even Jupiter. So Tesla stocks are rising. So the gains in Tesla stocks, they're offsetting the losses that you're facing in Apple stocks. And that's all within the index. So it's balancing each other out. You're not, of course, you would have invested if you were only invested in Tesla in that scenario. But imagine if the next year Tesla now tanks. So there's benefits in gaining exposure to a lot of things through one thing, which is what an index fund does for you. Same thing with the mutual fund. In fact, everything that has fund listed in it it gives you exposure to more than one thing within the asset class. So mutual funds, same thing. Some guys come together, pool the difference between like an index fund, a mutual fund, and ETF is really just technicalities, right? A mutual fund, some guys come together, they pool funds, then they pool maybe my $500, they take Grace's $500, they take Nina's $500, and they go and buy, maybe they say, oh, this mutual fund is going to be focused on technology stocks. So they go and buy, Apple, and they go and buy Alphabet, and they go and buy, what else is a tech company? Whatever. And then they put that in a mutual fund. So by investing in that fund, you're not gaining exposure to just one name. You're gaining exposure to several names, and that's a good way to diversify. Same thing with exchange traded funds. Literally the same thing I just said. Just that exchange traded funds, they can be traded on an exchange. That's the only difference. So I'll move on to fixed income. Now, like I said, let me go back to equities. The risk is relatively higher than normal. It's also not what you should put your money that you have immediate need for in. So I wouldn't consider it a very liquid investment. It's liquid in the fact that if you absolutely had to sell down your position, your stock, and get your money back, you can get it back. But you shouldn't, because you should be thinking more long term when you're investing in equities. Now, if it so happens that you bought a stock today, miraculously you made 80%, and you're fine, you can sell off and call it a day. But typically the play with stocks is to think more long term. So I'll move on to fixed income. Fixed income, like the name suggests, your income is fixed. You get into it and you know what you're going to earn. Think treasury bills, think bonds, think corporate bonds, think commercial papers. If you go to a Nigerian bank today and you want to buy a treasury bill, they will tell you that, oh, this 1 year treasury bill is 9%. It's not. It's just a hypothetical scenario. I think treasury bills are now, 1 year is now like 4.3%. It's really bad right now. But yeah, let's just use 9%. So you know that at the end of the year, I've given you this 1 million. You're going to give me back 1,090,000 naira at the end of the year. So it's relatively safe. In fact, treasury bills are, what they say about treasury bills, I know in the US, they're just called treasuries. In the US, it's just called treasuries. What they say is that they're backed by the full faith of the government. So for the US treasuries to default, right, or for you not to earn that 9% in the event that this was a US treasury that you bought at 9%, for you not to earn that, it literally means that the US government defaulted on its debt. And that has never happened. That can't happen. If that happens, then the world is ending, right? So these, there's no investment without risk, but these are considered risk-free. They're considered as low risk as possible. So treasury bills are like short-term, they're like 90 days to 1 year. Bonds are more long-term. Bonds can go from 3 or 5 years up until their 100-year bonds, their 30-year bonds, their 50-year bonds, their 20-year bonds. You can gain exposure to fixed income through mutual funds, like I said. Same explanation with equities, just that you're buying different bonds, or you're buying different treasury bills with different maturities, and you're putting them in a pool of funds that you've gathered, or you're buying them with pool of funds that you've gathered from different people. Same thing with exchange traded funds. It's just a fund, a fixed income fund that trades on an exchange. So what's the point of treasury bills or bonds? Now, governments need to borrow money, right? They very rarely is any government able to fully finance its budget, which is why you always hear like, oh, this country has a budget deficit or something. So sorry, I'm hearing. Okay, I'll just carry on. So governments need to borrow money to fund their budget deficits. So to fund that, they go to the market and they issue treasury bills to fund their deficit. That's really all it is. So if the US government comes to me to borrow money, and I go and bid for their treasury bills and they accept my rate and I'm able to buy US treasuries, for sure they're going to pay me back. Like I can't imagine a scenario where the US government defaults. In fact, I can hardly imagine a scenario where the Nigerian government defaults on its debt obligations. How much more the US government. Corporates also issue these bonds and commercial papers. So for government issue treasury bills, corporates issue commercial papers. Governments issue government bonds, corporates issue corporate bonds. So it's literally the same thing. A company has gone and they've drawn up their budget and they realize that they're unable to fund, their expenses with their income. So they're going to go and raise debt. And it's these instruments that are called fixed income. They are going to borrow and they're literally saying, give me this, I will give you 10%. And that's it. In Nigeria, treasury bills are easily accessible. You can walk into a bank and buy it. You can go to any asset manager and get it. I'm not sure how it works in the US, but I would imagine that typically you would have to go in through a fund in the US. So that's fixed income. Now, because the risk is low, there's always a risk and return trade-off. Because the risk is low, the potential for returns are quite limited. Like I said, in the US, 10-year treasuries, which will be your 10-year government bonds, they don't even return 2% per annum. I think it's like 1.9 or something like that. So the returns are they're kind of abysmal, but it's still better than zero. And it's a return, right? And before your inflation skyrocketed to 7%, it was a good return above inflation. So I'll move on to the next asset class, which is real estate. Real estate, as we all know, is real estate. It's property. You can either gain exposure to the real estate asset class by direct property ownership. So you own a building and maybe you rent it out. So then you have rental income. Or maybe you just buy a property for the sake of, I'm going to sell this in 5 years. So I'm just going to let it appreciate in value. And I'm going to be able to sell it for higher in 5 years. That's a form of investment. Also, you can gain exposure to real estate by something called REITs, real estate investment trusts. Think of these as funds, like I spoke of, for equities and fixed income. Some nice guy pulls monies together from a lot of people and then invest it in real estate, either commercial property or homes for people, and then he rents it out or he manages it or whatever, and then gets the income. When he gets the income, he distributes to the people who have put money together in his REIT, and that's it. People make gains from that. Real estate is safer than equities, but it's not as safe as fixed income. I have a chart that kind of just puts all of them in a risk return graph. But real estate is definitely safer than equities, but it's not as safe as fixed income because the real estate market can crash, as it did during the 2008 recession. Last is commodities. These aren't so popular with this isn't very popular for personal finance. Like you have to be like a hardcore trader to be investing in crude oil or to be investing in gold. Now it's not like you're investing in crude oil for the physical delivery of a barrel of crude oil to your house, but you're investing in it so these investments, they're cash settled, they're not physically settled. But like I said, these are relatively savvier, right? You need to be like a really savvy investor to be playing in these spaces. So I'm just going to I just put this here for your awareness. You can invest in gold. You can invest in crude oil. If you invested in crude oil at the start of the year, hey, you'll be making a killing now because crude oil, I think it crossed $100 per barrel, last week. So it's a valid asset class and it's a valid investment vehicle. So yeah, the others, again, they're even more advanced than commodities. Hedge funds. These are serious. These are asset classes where you can make a killing. These are also asset classes where you can literally erode your capital, right? So if you want hedge funds, we're not gonna get into that because I don't have them. I consider myself I think I take a bit more risk than usual, but I don't think I can do hedge funds as of now. So I've just put that there again for your information. Crypto, like I said, it's a valid asset class now. I think the entire world is still learning about crypto. So really, I know it's really, really popular right now, but you need to do the research for yourself. You need to, it's such a volatile asset class. You need to be very, very comfortable with the risk, or you just allocate maybe 5% of your net worth to it. Like, just put money that if you don't see that money again ever again, you're okay in it. I don't advise you to dabble with your entire net worth in crypto, but that's just me. Again, do your research and be comfortable with it before you get into it. People have made a killing from it. People have lost their entire money from it as well. So this is a chart I was talking about that kind of shows all the asset classes and how the risk return trade-off, right? So this is fixed income here, very little risk. In fact, it could be lower on this chart, but the return potential is very minimal. Real estate, slightly higher risk, return is fair. Equities, now you're getting into like the high risk territory, high return. Alternatives, like I spoke about, hedge funds and so on. These are guys that are taking short positions and doing all sorts of really sophisticated investing things. So it's high risk, but it has the potential to give really, really high returns as well. And then crypto, I honestly cannot even, if there's something outside of this, I will put it there because it is risky, but you can earn a lot from it. So yes, I also think it's important for you to kind of assess yourself and determine what your risk profile is. So are you risk averse? So I've spoken about a lot of the asset classes. If you're, and you know what, no judgments, right? I do think that we need to be, especially Nigerians or Africans, you need to be a bit more open-minded about risk. You need to be a bit more open-minded about risk. You do need to take a bit of risk. See risk as like a means to an end. You need to take a bit of risk to get the kind of returns that you want. The wealthy people in the world, right, or the best investors in the world are not people who invest in fixed income. They're people who have their entire savings in a money market fund or in an index fund somewhere, and that's just it. These guys play across a lot of these asset classes. So you need to be able to, the trick is to be able to diversify properly. In fact, in I think it's in one of my CFA books, they give a rule of thumb for how much allocation you should have to risky assets. And here, risky assets would literally be the three to the right? So they say, take out your age from 120, and that is the percentage of your net worth or your income that you should put in a risky asset. So if you're in your 20s, you're literally saying you should have more than 90% of your net worth in risky assets. And I mean, maybe it's a bit much for a conservative African or conservative Africans like us, but there's some truth in it, because you do have time to make up for any losses. You really you have a lot of time. You have an investment time horizon of, if you're 20, you're looking at like 40 years before you retire, right? Because the idea is that, okay, I lose all my money, but I have a job, I'm going to earn my next salary, and I will pick it up from there. So they kind of they measure your investment time horizon with your current age to when you likely retire. So if you're retiring at 60 and you're in your 20s, you have over 30 years. The market does move in cycles. That's one thing. The market always corrects. There's always bull and bear seasons in the market. So the market always corrects. There will always be times to make gains. There will always be times when, the market kind of crashes on you. What's important is just that the gains are more than the times that it crashes. And that is what has happened historically. So again, you need to think about risk in a different way. Don't think, oh, I don't want to invest in the stock market because your money can go. People did lose their money in 2008, but the market has recovered since then, right? So you need to think of it as a trade-off. You take some risk so that you can get higher returns. Warren Buffett did not become Warren Buffett by investing in US treasuries. He absolutely did not. Warren Buffett has lots of allocation to real estate, lots of allocation to equities. an extraordinary amount of allocation to alternatives, because what he does is he invests, he does private equity as well. And private equity falls under here. It's not, public equity is actually safer than private equity. So you need to be able to diversify across a lot of these asset classes and take some risk. Don't put all your money in risky assets. So, I don't advise that, but don't put all your money in fixed income. You have to be open to taking some risk. So yeah, determine what your risk profile is. At the end of the day, if you're risk averse, it means that you should be allocating more to these assets, because you also want to be able to sleep at night, right? And not have heart palpitations. So be allocating more to the bottom three. But if you think you can take a lot more risk, then be allocating a lot more to here, right? The top three asset classes. Yeah. So we're winding down. So finally, I'd say that the best time to start investing is now. I put this as one of the things that I was hoping you would gain from this class, is when the right time to invest when the right time to invest is, but the right time to invest is now. I find that people always try to time the market. The market is the US. By the market right now, I mean like the US stock market. Right now it's red. It's pretty red. I think there was some respite this last week, but by and large, year to date, it's been really bad. But don't ask it, I think it's gonna go down a bit more, and then wait. No, like that's not the smart thing to do, because you really cannot time the market. Trust me, the best of traders, the best of portfolio managers think they can time the market, and then you just find out that, I missed a good time to invest, So don't waste time trying to time the market. Rather, you should do this thing called dollar cost averaging. And what this means is that if you say you have $500 to invest in the US stock market, don't invest all your $500 right now. So do $100 today, do another 100 in another month, and another 100 in another month, and another 100 like that. That way, if you were right and the market kept going down, this is you that thought, let me wait till the market goes down for that. If you were right and the market kept going down, that's fine, because your average cost, right, is, okay, let me give an actual scenario. So maybe you wanted to buy shares in Grace Company, and Grace Company right now is at $100. Let's use $20. So you have $500, $20 per share, right? So you have $500 to invest in Grace Company. So what you would do is take your first $100, invest in Grace Company that's at 20. So you get 5 shares today, right? In the next month, say Grace Company has gone down to $18. Sorry, Grace, your company will not go down, but it's just an example. You will take your $100 and invest at 18 naira, right? That way you get more shares. I don't know what 100 divided by 18 is, but do the math. It's more than the 5 that you got the first time. The next time, maybe it's at 15. Do 100 divided by 15. You get a lot more shares. So that way your average is lower than your initial, spend. Same way, if, Grace Company was going higher, your average is still lower than the highest point that you bought at. And that's what dollar cost averaging is. So rather than trying to time the market, you're going to go crazy trying to time the market. The market, I work in finance, and sometimes some of the things that move the market, I'm like, wait, nobody even thought of that. Like, nobody thought that that was something that could happen. Or that was something that could have such an impact. So you can't time the market. People, they're finance professionals that miss, big turning points in the market. So for your peace of mind, just practice dollar cost averaging. Don't put all your money in the thing right now. If you have it, if you're fine to do it right now, that's fine. But typically, best practice is to kind of do it. Stagger your investment over a certain period of time. And like I said, when I was talking about equities, think of investing as a long-term play and try not to sweat the temporary losses. It's just a bear market, it's always going to go back up. Like, markets don't stay down forever. They really don't, so if you're thinking more long-term, you're not going to be opening your in Nigeria. Well, I use Bamboo for my investment in US stocks. So you're not going to be opening your Bamboo app, every day trying to see, oh, and it was red today, and I thought, you're gonna go crazy, looking at what your return is daily. Just think more long term. And also, lastly, the internet is your friend. There's so many, and so many resources on the internet in terms of how to get started with investing. I could just drop some tips. In the US, I like Vanguard is pretty popular and Fidelity is pretty popular. So I like those two. I have colleagues who invest through those two. I don't, because I don't have that much money. But those are pretty popular. And they have a lot of funds, those funds that I spoke about. And funds are a good way to get started. If you're new, don't go and gain exposure to just one stock immediately, only if you're so sure about that stock. You're usually better off starting out through a fund, right? And I know that outside of these two, there's so many like brokerage firms, asset management firms in the US, so many. So just Google, there are robo-advisors on the internet. Some of these, I know Vanguard has a robo-advisor. Fidelity does as well. You can just, robo-advisors are like they're bots, right? And they just ask you a couple of questions about what you want to invest or how you want to invest, what your age is, and they make some good suggestions for you. These things they're AI trained over and over and over again. These are machines that have learned, so they're able to give you good suggestions, and you can just pick what suits you. There are many videos on YouTube. There are many things online. If you're in Nigeria, we also have a plethora of asset management firms that are SEC registered, right? So I'm just going to name a few names: Stanbic, First Bank. I worked at AXA, Chapel Hill. There's a number of them, and all of them, like I said, so many of them have funds that you can literally get started with investing at little as 1,000 naira. Now, outside of these, brick and mortar SEC-registered asset management firms, there are lots and lots of savings and investing apps in Nigeria now that are just springing up. It's like a dozen a day. Them. I don't need to start mentioning them. I've mentioned Bamboo. Bamboo gives you exposure to US equities from Nigeria. But there are apps that give you exposure to Nigerian equities. There are apps that have mutual funds as well. Some people do agri investing. I'm kind of iffy on agri investing or agro investing. I'm actually not very keen on it, so I won't speak to that. But there are many apps that do that give you lots of options, right? So it's really not these days, investing is not a thing to be confused about, because the information is out there and it's in excess, and you can easily tap into it. So I hope, I know you guys shared some of the things that you'd have liked to gain from the session. I hope that I've answered them. Thank you very much. And thank you again, Grace, for asking me to do this.
Thank you so much.
Thank you.
Thank you. If you have any questions, you can just raise your hand. That's your virtual hand. You can raise it while I ask some of the questions in the chat box. So someone asked, please, what do you think about people saying never borrow money you can't do away
with? So what's the purpose of the money, right? Never borrow money. Never borrow money
you can't do away with. That was what, yeah.
Okay, so this
could be. Explain. If I don't know if she wants to explain.
Yeah, so basically, in terms of it all boils down to when you want to borrow somebody money, where do you kind of draw the line in what percentage you can actually do away with, how much you can actually give the person, because people have a couple of people have this idea that, okay, if you want to borrow someone money, you shouldn't borrow money that you cannot give out to the person, okay, take, I don't want you to return the money, because most times people may not return your money. So having this idea of, okay, if I'm borrowing this money, it means that, okay, you're not telling the person, but at the back of your mind, you're just well, if the person returns the money, fine. If the person doesn't return the money, it's still fine.
I agree with that sentiment, right? But I think it's not an easy question to answer, because circumstances differ. Who's this person to you, right? But if if this is, someone that you're having to take this kind of decisions, about like, oh, I'm not gonna borrow you money that I can't afford to lose, then I'd imagine that you're not as close with the person. So yes, I do share the sentiment, especially if you're borrowing them for free, right? You're basically giving them money and they're not paying you interest back. For sure. Just I think you should just borrow what you're willing to lose, right? Yeah. So I agree with that sentiment. Like, don't borrow people more than you're willing to lose. And I'm saying that because of the way you describe the scenario. It sounds like the person isn't close. I mean, if it's your mom, obviously, you're gonna borrow her as much as she needs. But if it's someone that you're not as close with, then for sure, I agree with the sentiment.
Yeah,
does that answer it? Okay. All right.
Yeah.
So we have another question. Can you please advise on kind of investment to grow wealth, since fixed deposits is not encouraging in this present Nigeria?
Yeah, fixed deposits the rates are terrible, and the rates are terrible because treasury bill rates have damn near crashed, right? At the last auction, I think it was 4.3, which is terrible. I mean, you have inflation at 15.6%. The ideal thing is that the treasury bill rates of any country should be returning above inflation rates, right? It should be returning, I think the rule of thumb is 2% above inflation rate. So the fact that our treasury bill is literally giving you negative 11% in terms of real return is terrible. So what can you do outside of that? So for people in Nigeria right now, my main advice is to kind of move away from Naira investment. If you can convert a portion of your income to dollars, I would advise that. Even if you just converted to dollars and you kept it under your pillow, I assure you, because of the way the Naira is basically is free falling at the moment, you will make a return on the current, like in terms of currency gains, right? So I would advise switching over to US dollar investments, investments in the US stock market, for example. If you can go longer term, you can invest in bonds. Bonds in Nigeria, some of them, from about 7 years and up, they are returning at least double digits. So you're getting at least 10%, which is, better than what fixed deposits are giving you now. So if you can go longer term, speak to your asset manager and tell them that you would like to invest in a 10-year bond, a 20-year bond, they could set that up for you. You can invest in the Nigerian equity market. Now, in that one, we don't have index funds in Nigeria like that. We don't have ETFs. So if you're investing in equities, you have to, be taking direct exposure in a counter, in a name. So you do your research and figure out what stock you think is going to appreciate within the time frame that you have and invest in that. But by and large, I'll say bonds. No, I'll say your first option is to try and invest away from Nigeria. Also, if you can get into real estate, that looks to be doing well right now. I'm not very, very pro real estate in Nigeria, but it looks to be doing well right now. On US dollar investment, honestly, if you can convert your money to dollars and just invest through, and it's nothing elaborate. Like I said, I use Bamboo, but that investment that's a stock market investment, right? It's an equity investment. So maybe that's a bit too risky for you since you're doing fixed deposits. You can try this app called RiseVest. So they have fixed income US dollar investments, they have real estate US dollar investments, and they have equity US dollar investments. You can invest through them. The returns are definitely better than fixed deposit returns as they are right now. So yeah, basically bonds, US dollar investments, actually US dollar investment first, then you can start looking at bonds, then you can look at the Nigerian equity market. So any of those three, or real estate, right? That's the fourth option. Yeah.
Mm-hmm. Thank you for that. Hope, I think you want to say something. You can unmute.
Yes. Based on what she just said now, thank you very much for the presentation. You said you can convert maybe part of your pay to dollar, and then you now invest on, you advise to invest on US dollar. How do we get that?
Okay, so let me just give you an example with RiseVest, right? This is an app that's available to Nigerians, and I don't work for any of these people, so this is not some promotion for them. But if you download the RiseVest app, it's pretty easy to get started. Actually, on the RiseVest app, you can actually fund your account with your Naira card, right? That's what I do. So you fund it with your Naira card. They help you exchange it. Of course, unfortunately, it has to be black market exchange rate. So they're exchanging for you at near 600. But that's what it is, right? There's really not much you can do about it. So you get dollars, and on that app, you're able to invest in. They have a fund for US equities. They have a fund for US fixed income, and they have a fund for US real estate. So download RiseVest. That's the name of the app. If you just want equities, you can do that through Bamboo. I believe Chaka does that as well. There's so many, honestly. If you literally just did a Google search on, you can even just go to like Play Store and do investment apps or whatever, and just pick a random metric to use to preset. Maybe the one with the highest rating, or the one, I think you should do more thorough research than that. But really, just go to their website, read up what they do. You can do a search on Twitter about what people are saying about them. Personally, I use RiseVest and Bamboo, so I can speak to those two. But I know that outside of those two, there are a lot. And with these apps, you're able to fund it with your Naira card, right? So, yeah, I hope that helps.
Thank you very much. Thank you.
Yeah.
Sorry, Gracie, I have a question in the chat box.
I can ask. Do you want to ask? You can ask it.
No, you can ask it. Thanks.
Okay. So we have another question. Is it advisable to borrow money from the bank for investments? And if yes, what kind of investment can you advise to do?
Okay. Is it advisable to borrow money from the bank for investment? Short answer, no. But again, the thing with questions about investing is you need context, and you need to do space for nuance in some of these conversations. If it's that you're starting a business, bear in mind that that's a form of investing, right? If you're starting a business, consider that private equity investing. You're putting your own money in your business, part of that business, then that's fair. That's fine. And you're doing that because you are certain, you have done your analysis, and the return that you will make on this investment, on this business that you're starting, will help you offset the interest that you're going to have to pay to the bank. Now, I know that Nigerian banks don't borrow for cheap, So if you're borrowing from a Nigerian bank to invest, I'm struggling to find that investment that will give you returns that are higher than the interest that you need to pay back that Nigerian bank, which is why my short answer was no. But if you're putting it in a business and you're so certain, and maybe not even 100% certain, but you have a decent level of certainty that the return on this investment will be higher than the interest I had to pay back to the bank, then go for it. But if it's that, I'm going to borrow from the bank to go and buy treasury bills, no, I don't know. No.
Thank you for that. And then the last question here is,
Okay.
Since you said it's best to keep our money in hard currency, what kind of investments can we do in dollars?
Yeah, so I think I answered that when I answered the other question. I think the US equity market is, it's the largest equity market in the world. It's really easy to gain exposure to it. I'll say you can do this if you're in Nigeria. You can do this through those apps that I mentioned. I'll mention them again: RiseVest and Bamboo. I don't work for these people. I feel like they should be paying me at this point because I mentioned them so many times. But yes, I've used these two for at least over almost 2 years at this point. So I have a level of confidence in them. So yeah. And these, you don't even need to go and change your money with one Abuki and then pay into you can fund, like I said, with your Naira card. So you can fund with Naira and they'll help you convert and you can invest. So it's now, they have a wide array of options. It's now left to you like I said, you determine what your risk profile is. Well, if I like risk, then I'm going to invest in the equity, investment. If I don't like risk, I'm going to invest in the fixed income investment. If I'm moderate, I'm going to invest in the real estate investment. I think RiseVest actually does a good job of analyzing each investment group that they have, and telling you what kind of personality you need to have to be able to invest in this. So yeah, any of those two, or any of the many others that I just can't seem to remember their names right now.
Mm-hmm. Thank you for that. Then I have my own question. I think I've asked you before. What's about agriculture?
I literally said, I told you now that
I know,
I literally said it in this. Man, I just struggle with it, right? So they'll say that, oh, they're doing cashew investing and you're earning 30%. So in going through, and again, maybe I'm just a bit too informed to be able to just overlook some things. I look at a lot of their investment prospectus or whatever, and I'm not sure what they're saying. Like some of them you see, insured by Leadway, right? And then there was time Leadway actually came out and put out a statement that, we're not insuring your money. What we're insuring is maybe like a portion of the farmland. Or the communication that comes out around agri investing, it just seems like very dodgy. Maybe I'm a bit too biased. And then you always hear of somebody not paying somebody their money, right? There's always some agri investing scandal. If it's not, let me not badmouth anyone's business, but like there's always somebody that hasn't paid, the investors their money. There's one that's good. In fact, I just saw it like 2 days ago. I'm like, not these agri investments again. There was one that was so bad. They did it through. They had issued through, I can't believe I haven't mentioned PiggyVest throughout this, but PiggyVest, I'm sure you guys know PiggyVest, it's pretty popular. So they had issued through PiggyVest, and these guys defaulted, and PiggyVest had to dip into their own pockets and pay the investors that came in through their app, because these guys they had defaulted. So you're not seeing the farmland. You're literally just believing one guy somewhere. It has worked out for a lot of people, and I can't lie about that. But I have issues trusting that segment of the investing market, and that is just me, right? And I have a lot of colleagues that share this sentiment. But what I see is that many people who don't work in finance are pretty okay with it. So I feel like it might be a case of I know too much, or maybe I can read through the bullshit in what they're saying, and it's just not, it's just not making sense to me. But many people invest in all these agri things, and many times they pay you, right? So approach with caution, but at your own risk or whatever. But yeah, I don't advise it personally. Yeah.
So I think Tommy says here that PiggyVest saved her finances in Nigeria and gave interest with the Flex Dollars accounts. Okay, I wanted to say something.
PiggyVest has a dollar thing too. Yes, I don't know why I didn't remember them, but yeah.
So I wanted to say something. I know you were saying, I'm sure you guys know about this. I'm sure you guys know about that, but I'm sure there's some people who don't even know anything, right? About all of it. So where should we start? If we've not had any experience with investments before, savings, if it's just a little bit, budgeting, we've not really done so much. How can we start? How you were talking about beer and beer. Some people may not know that. You only know the animals. So exactly how do we start?
Okay, I apologize.
I'm just saying.
Yeah. How do you start? If you're in Nigeria, like I said, so many apps. You can literally start tonight. Just go and download one of these apps. You have to read up on the one that you like. I'm going to say names of the ones that I advise. If you're looking for really safe Naira investments, I think you should go through one of the SEC registered asset managers. SEC is the Securities and Exchange Commission in Nigeria. It's an agency of the government. A lot of these asset managers are SEC registered. These are the brick and mortar ones. So Stanbic, IBTC Bank, they have an asset management firm. You can go and open a mutual fund account with money market funds. Are a good place to start. Money market fund is literally the pure water of investing in Nigeria. So just write that down. Invest in a money market fund with one of the SEC-registered asset managers in Nigeria. If you're in Nigeria, that's the best way to start. Some names that I'll give you: Stanbic. I worked at AXA, so I'm going to plug them. AXA Mansard. First Bank. They have I think their asset management firm is called FPN Quest. Outside of that, there's at least 30 of them. Just go and Google, just Google money market fund in Nigeria. You'll find United Capital. That's a good one as well. ARM. Oh my God, I really like ARM. So ARM is a good one as well. So just go, and many of them, I know for AXA, you literally can set up your account tonight. Like they're competing with those apps. So they've been forced to be, very tech savvy as well. So the way you can open your PiggyVest account tonight, you can open an account with AXA Mansard Money Market Fund tonight. So that's the best way to start if you're in Nigeria. I think money market fund is like the first go-to. And then once you now put in fact, literally take all the money in your bank account and move it to money. I promise you, that's the way to go. Take all the money in your Naira account and move it into your money market fund. With AXA Mansard, you can liquidate your money. I think if it's under 300,000 Naira, you get it immediately. At this point, if it's above 300K, then I think it takes like 2 hours. But yeah, you're able to liquidate in less than 1 hour. For an investment that's giving you returns, that's better than any bank account. Bank accounts don't get me started on bank accounts. Anyway, so if you're in Nigeria, that's a good way to start. If you're in America, you're even luckier. The resources are unlimited. Like I said, I know of Vanguard and I know of Fidelity. They have a lot of funds. If you're in America, I would advise that you don't start with a money market fund, because your own money market instruments don't yield as high. In Nigeria, at least, like I said, treasury bills are 4%, but that's bad in Nigeria, but that's amazing in America, because you guys literally can never get that, right? You guys will probably have like 1%, 2%. So I'd advise that you start with an equity market index fund. So like a fund that mirrors the S&P 500, which is an index in the US, for example. So get on, the Vanguard website or the Fidelity website, or just go to your local, I know Grace, when we're conversing, you had some guy that you were reaching out to, and it sounded like he was like really close to you, or local, like he was in your vicinity, right? It wasn't like a Vanguard or a Fidelity. So I'm sure there are many brokerage firms or investment firms around that you can literally walk into or just Google. But a good way to start, if you're in the US, I'd advise index funds. If you're in Nigeria, I'd advise money market funds. Yeah.
Wow, thank you so much. That has been enlightening. I think you can stop sharing your. Let me stop.
Okay, I can. Yeah.
See your face and we can see everyone. I'm sure it's been enlightening. Everyone. Can we just thank Oyinkansola Samuel for this wonderful, insightful session? What is the minimum? Oh, another person is asking. So Hope is saying, what is the minimum investment in all of this?
So I might have to get back to her on the US bit, but in Nigeria,
in Nigeria.
1,000. Oh, in Nigeria, 1,000. I think. Wait, for AXA, I think it's 2K. Okay. For Stanbic, maybe 5K. Some guys do 1K. It's really nothing. It's nothing elaborate at all.
Okay.
Yeah.
So let's thank Oyinkansola in the chat box. Let's thank her. If you want to unmute, you can also unmute and just thank her. Let's thank her for the time, for the efforts, for the information, for the slides,
Thank you.
Not easy. So let's thank her. And if you need to reach out to her, Oyinko, can you put your email in the chat box just so people can.
Okay, so are you in Nigeria?
Yes, I'm in Lagos, Nigeria at the moment.
Okay, you can also give us your number if we can chat you up if we need anything.
Yeah, I'm sure easily, emails can work better, right?
Yeah, emails work better, actually.
Yeah.
All right. Thank you. Thanks so much.
Yeah. Thank you. Thank you. So, I think we'll just continue recording. We're going to have the next BFM chat in May. So the second to the last Saturday in May. And that's going to be on career. So of course, we're looking forward. I'll send out emails or messages to the people who registered. And we're going to have the next one. That's going to be career advancement. How can we move? How can we network? How can we, do all of those kind of things? And I'm sure that's going to be really interesting also. So we're looking forward to having everyone join. And if you don't know anything about the BFM community, that's the beauty from the MESS community. It's a community for women, for ladies, walking in identity and purpose, right? And we have several things, our core pillars on identity, on purpose, on mind renewal, and on our relationship with God. And we do several things, in the community, reading our books. We have books that we read and we discuss weekly. We have the BFM chats also. We have a conference, which is coming up in July. We had one last year that was really awesome. We're having that also. We have several things. We do our prayer sessions every month, the last Sunday of every month, which is going to be tomorrow. And so several things here and there that we do, definitely. And of course, I think I'll send emails, so you can know more about what we do in the BFM community. And definitely, of course, more of this BFM chats. And also, we're going to be looking at, having quarterly chats around the core pillars of identity, the core pillars, of purpose, relationship with God, and mind renewal. And so the first core pillar, the quarterly chat on the first core pillar is going to come up in March. So yeah, that's the first quarter. So we're going to have a talk on identity. I'll send that out to everyone. So yeah, thank you for, coming for this finance session. And I hope you're not just here to listen, but you're here to apply all the things you've learned. So it's not just to, waste your time, come here, listen to finance or budgeting, investment, savings, but it's really to apply it. It's really to apply it. And if you're in the BFM community, definitely we're going to keep you accountable. So I wish you a wonderful evening wherever you are. I wish you a wonderful afternoon and see you soon. Bye.
Thank you.